Good morning, everybody, and thank you for joining us here today. We have a presentation from the Managing Director of Metro Mining and supported by the Chief Financial Officer, Mr. Nathan Quinlan. Simon Wensley will give us a rundown on the quarterly and a bit of an update and outlook on what he thinks is to come. So I'm going to hand it over to Simon, and there'll be an opportunity for questions at the end of the presentation. Over to you, Simon.
Thanks, Peter. Good morning, everybody, wherever you are, and a belated Happy New Year to those who I haven't spoken to or seen since the New Year. So, look, just a reminder: if you want to ask a question, we'll try and leave some time at the end and put them through on the chat function on the through the webinar. I might just share the screen to put up the actual quarterly report, which I hope that you've had a chance to have a look at. The highlights really there speak for themselves. It was a good year. It was a good year in all, and actually a good quarter. I mean, another record quarter. It was slightly above the production rate of the third quarter, and indeed we ended the season with meeting guidance. We also demonstrated the run rates of 6 million tons consistently through the quarter. But interestingly and importantly, even in a difficult December, we demonstrated some days where we demonstrated the 7 million ton rate. So I mean that equates to about 23,000 tons per day for the sort of 6 million ton rate, and about 28,000 tons per day for the 7 million ton rate. So it was really, really important for us to demonstrate that the system, even without having some of the new pieces of equipment and so on that are still arriving, that we were still able to demonstrate that output for next year. Obviously, as a bulk commodity, our throughput is absolutely critical. And so those rates really do underpin still our target for 2024 of 6 to 7 million tons. We're just going through our budgeting process at the moment, and so at a later stage, I'll put a more sort of official guidance out there. But look, at this point, given what we've achieved in 2023, that is still our target. I might just bring up later in the presentation. There is a very good graph that shows sort of how the year went. So I hope you can all see that. And the lower two lines are the 2022 results, and then the upper two lines are the mining and shipping for 2023. And you can see through the year we started off pretty much at the same rate where we ended in 2022, and then we continued to build with a few little bumps and hiccups, but and peaks and troughs through the year. But there's a very, very steady and pleasing improvement in output all the way through the year. And that was exactly what we were trying to achieve through 2023. It was about, as elements of our expansion came into play, whether it was mobile equipment, fixed plant, marine assets, etc., through the year, we tried to take advantage of that at the time by implementing some innovative ways of getting more tons onto ships. And so right the way through the year, we started, as you can see, at that 4 million ton rate where we ended 2022. Then we raised our game to 5 million tons, and then 6 million tons sort of rate achieved on average through that fourth quarter. And then you can see, as I said, that peaking just before Cyclone Jasper hit in December, where we were heading up to that sort of 6.5 million ton rate. And as I said, on certain days we were demonstrating. We hit a couple of days at 28,000 tons per day, and that is a really good indicator for next year. Look, the cyclone, in terms of the quarter, that last sort of 3 weeks, the 2/3 of December, we had the first cyclone in December in the Cape for about 30 years, and of course, look, we use relatively scientific, predictive technologies to look at weather. But those of you who are in this game will understand that it's a really difficult thing to do. We look at past averages, we look at the future, and look, there's an element of luck in this. At the beginning of December, we had, we were going strong. We were heading for that 5 million ton, the top of guidance. We had no reason to believe that wasn't going to be able to be met. We did factor in what you might call normal weather interruptions, which in December tends to be, larger storms that you get running through. They tend to be relatively short, but heavy in nature, and we're set up for that now more and more. But obviously, a cyclone is quite different. If you watch the TV, you would have seen the tremendous sort of rainfall that accompanied this system, and it was a very large system. So it started to affect our shipping conditions well before the cyclone hit onto the eastern side of the Cape, and then and that's because it changes. The system changed the direction of the wind and the waves and the energy of the waves, and that created unsafe conditions for our tugs and barges and our floating crane. And that's it is what it is when it comes to that, and we have to take safety very seriously. Then what followed on, once the cyclone had sort of tracked to the south, and we didn't hit our site directly, if you like, but obviously the rainfall that then accompanied in the second half of that was tremendous, and that left us in a difficult position. Now we did restart, and we got another 100,000 tons out over the rails at the post the cyclone, but it was pretty difficult. We had a couple of pits that were flooded, and it was it was a pretty difficult position. Now, going forward, you've heard us talk about the way we're trying to create more resilience in Metro to create less variability. We've done quite a lot of that through this year already, but the two major pieces of investment that we are making that will do that are the wobbler screen circuit. So that screening circuit is a much more effective in wet weather or damp ore conditions. That's exactly what it's designed for, and so we'll see a much lower effect on screening performance once we get that system in place. And of course, the new floating terminal, and the floating terminal is a much bigger vessel. I hope that we can at some point show a picture of the two floating, the transshipping assets next to each other. You'll see how big the OFT Ikamba is. It's at least 4 times bigger from an area perspective, and so that vessel has demonstrated already in its life its ability to work in more difficult conditions. So that again is part of our strategy to try to increase the resilience of this. Obviously, a cyclone is a cyclone, and that's a bit more of a difficult thing to handle, but in terms of just dealing with the vagaries of wind, waves, and rain, we are certainly putting in place strategies that will make them less and less impactful on our business. So look, I think overall I'm extremely pleased with that. The team's working really well together. The new mobile equipment we brought on, the new Scania trucks running with the 4 quad trailers, they're doing it almost in the same cycle time that the previous fleet were doing with the 3 trailers. We're getting bigger mobile equipment coming through. We've had an extra barge arrive already in the 4th quarter this year. That really did help us, was part of the way we lifted our production, and we're getting 2 more of those larger barges arriving in March this year as well, so before the season starts. So we'll then have a fleet of 6 large 90-meter barges to be able to run around, and to be able to hit the top end of our production. We only need 5 of those to be loaded in a day, and so the system we're setting up is about trying to get 5 barges loaded and unloaded during the operating day. Let me talk a bit more about the market. Look, and this is very relevant for the decisions that we made around funding, but I'll start to talk about the market. So we just found out just before the quarterly that the numbers the traded market will continue to be pretty strong during the last quarter. The annual imports, for example, into China, which is the major recipient of traded bauxite, that hit another record in 2023. So 142 million tons of imports, which is about 13% over the 2022 number. So you can see that's a function of both, the top end demand. So demand is increasing for bauxite in China. So you get that top end growth, the top line in this graph, and you're also seeing the bottom line sort of fading away to an extent. So you've got the domestic bauxite, which has underpinned, Chinese alumina production for many decades, is fading away slowly. So you can see, that wedge shape getting larger and larger. So that's why we're getting these sort of significant double digit growths in demand from China. So above the natural GDP or GDP plus that you might expect from the aluminium sector generally. That's also being obviously reflected in pricing. Of course, there is growth in supply at the same time, but you're seeing, with that kind of growth, it's difficult for the major supply countries to bring on that sort of capacity. Guinea has been adding a lot of capacity, but that has only really just replaced what's left the market, with Indonesia leaving in 2023. So you can see tightness in the market, and particularly as the domestic bauxite constraints hit in China, you're seeing that increased demand. And you can see, I haven't shown this scale of graph before. I've shown a much more longer term cyclical graph going back to 2016. But when you look at the shorter term here between the beginning of 22 and now, you can see that the growth in the market has been substantial. And I think, maybe uranium aside, there aren't very many other commodities that have shown this kind of robust and strong growth without the volatility in there. When you talk about lithium, or you talk about the coppers or whatever, you've seen a lot of volatility, and certainly 2023 wasn't a good year for most of those commodities. So look, bauxite, the market is tight. That wedge shape is continuing, and these prices are rising. And I think that was a major factor in our deliberations around the funding, which I'll come on to a little bit later. I'll just touch on the project side of things quickly. As I said, the two major elements of the project remaining to be put in place are the floating terminal. So you can see that we've got a nice picture of Ikamba passing through the Indonesian islands. Ikamba, I can tell you, hot off the press, has arrived in Darwin this morning. So it's made very good time from Shenzhen to Darwin. I'm seeing emails coming in with the master negotiating with the port authorities about which wharf to put her on. So she's there safe and sound, and we'll start to go through the importation and the marine regulatory processes to get her place secured in Australia. So that's happening as we speak. Look, the shipyard process took a bit longer than we had anticipated, and that was we wanted to make sure that we'd done what was sensible to do in a shipyard, rather than doing renovation or repairs or refurbishment on the run. So look, it was a deliberate decision to try to in any refurbishment, those of you who've refurbished bits of equipment or your houses know that you never quite know until you start taking things apart and pulling back the walls and taking equipment apart, that you don't quite know until you get in there what needs to be done. And there was an additional sort of scope of work that we had to put in place to ensure that we got her in a good condition to be operating. We want her to be in a good condition this year. There'll be a commissioning period and a ramp up phase like any other pieces of equipment, and we wanted to make sure we did the sensible scope of work in a shipyard that was better done there. And then we were trying to test all of the pieces of kit to the extent that we could in a shipyard before we left. So that took longer. Obviously, that cost a bit more than we might have thought initially. The other aspect, I think, was really the towage. At the moment, the oil and gas sector is pretty strong, and the sort of tugs that we need to tow this thing around are large, the sort of tugs that tow oil rigs and things like that. So for deep ocean tows, we don't need those tugs around the operation in shallow coastal waters. But when we're pulling this thing across the ocean, we take a very, I guess, conservative approach to the sort of size and power of the tug, and we're price takers in that market. And obviously, with the fuel price where it was as well, that the budget we had for towage has been exceeded as well. So we've seen some creep in the last few weeks over as we get those numbers in on the budget for the expansion. The wobbler system is in shape. Everything's manufactured. It's all either on site now or in cairns, waiting to get across. The team is on the ground. We've already got the civil works sort of in train. The wobbler and the apron feeder, the conveyors, etc., waiting to get on a barge this week. So that's all going to plan at the moment. There is we have had normal. Despite all of the predictions, we've had a pretty normal wet season so far up in the Cape. So there's weather contingency built into those plans. But we're aiming, and we believe that both of these pieces of kit will be in place for the end of March. Look, just a quick note on the funding. Obviously, we've assessed that roughly the cyclone impact, when you take into account the shipping, and we had all of the ships that we needed to do roughly 5 million tons were either at the site or on their way. We have to book vessels, roughly 30 days, maybe 25 days in advance. So we don't have the luxury of sort of waiting to the last minute. We made the call. That was the call we made. We've been pretty aggressive as a company over the last couple of years to try and turn this company around. Look, most of the calls have gone the way we thought, but look, now and again you get one that doesn't, and that was reflective in some of the costs. So once you've got vessels waiting on site and then being diverted, we had to actually take 2 vessels and send them off to do other tasks. The costs involved in that are quite significant. So there's probably about a third of the cost that we've assessed is in the shipping side of things. And then, all of the other costs at the site are all committed to as well. So the labor, all of our transshipping, the equipment, those are all fixed costs. So our variable margin is quite large, and so we missed out on probably 300,000 to 400,000 tons of sales, and at $20-25 a ton, then of variable margin, you can see where the rest of that money comes from. So look, that is what it is. Our performance has been excellent through the year, but as we've been disclosing all the way through the year, fuel in particular has been way above our budget, and so that's probably cost us at least $2 a ton in our EBITDA margin through the year, and that left us, I guess, with not a lot of financial capacity left at the end of the year. Not that we were in desperate straits, but we'd been negotiating already with our lenders to provide some buffer capacity, and that negotiation just, I guess, upsized, if you like, through the end of December and into January to get the amount that we need. And we needed the funds. We need the funds to make sure we can complete this expansion at the revised capex, get all the maintenance done, get the working capital ready to get into operation, and then get going. And I think we looked, obviously the board considered equity, a whole range of options in terms of funding, and equity was definitely there. I mean, I guess with our share price where it was, with a further discount being required to put that in place, then that was obviously going to be a difficult thing for shareholders to to stomach, and we felt very strongly about trying to do the right thing for shareholders. And so look, we recognize that what we've put in place is effectively more debt here, but we wouldn't have done that had we not had that outlook on the market, which we think is strong, and also on our confidence on 2024's production, which, having demonstrated a lot of that, and with this new equipment coming through, we felt very confident about that as well. So we felt the short-term bridge was better for shareholders than a dilutive equity raise, and I suppose, look, time will tell, but that's the choice that we made. Okay, look, there's obviously information on margins and so on here, which is easy to read. But look, we've got about 10 minutes left, and Peter, happy to take questions.
All right, thanks, Simon. We've got some good ones coming through. One of the best ones I had so far was, will we do the next quarterly webinar from the decks of the Akamba?
Okay, that's a deal. Assuming we can get our Starlink, if Mr. Musk plays ball with us on getting our Starlink uploads up in time, we'll try and do that at the end of April.
Yeah, it sounds like it was a cocktail party to finish. Good question here. Assuming all things go to plan, what's the thinking around the debt pay down and shareholder returns going forward, with 50% of free cash flow, mix of dividends and buybacks seem appropriate for 25?
Yeah, that's a great question. And yeah, probably the question sort of nailed the answer almost, I think. Look, so this year we've got 32 million of the junior debt to pay back. We've just taken on that additional working capital facility, so that will come into play this year as well. That being done, I mean, our projected cash flow does provide for a surplus over that. So our net debt, our net debt to cash should be in a better position at that point. The Nebari loan starts to be paid down in 2025, so we've got to make sure that we've got that. That was a 4-year facility, so we're now entering the second year of that facility. So we've got a couple of years to pay that down. So that will obviously have to factor into our thinking, and then we've got the royalty, which of course our firm aim is to buy that royalty back. And that the structure of that royalty is deliberate to obviously provide a fallback position should we not be able to do it. But our firm, we didn't want to have a long-term legacy sort of drain on margin coming from that additional royalty. So it was something we could put in place quickly, and something that was structured to give us the flexibility. So look, I think that's the plan. If we can get through to close to that, in that 6 to 7 million ton range, that does deliver, and we can get close to that target of $15 a ton average margin for the year. That will be the firm target. Once we get into 25, then certainly a buyback would certainly help our share, the number of shares on offer. So that's certainly something we're thinking, we would be thinking about. And if we have surplus cash, I'm certainly not going to sort of create this war chest and start making silly acquisitions. And we do want to grow the business, but if we do have spare cash, we will be trying to return that to shareholders who've been with us through the years. So look, I think it's all there. Everything's up for grabs. I think once we sort of start to pay that debt down to another level, to a level that we're much more comfortable with relative to the market cap. So I'm hoping what we see is debt coming down, market cap going up, and we then in a much better, I guess a sort of a sustainable position from that point of view.
Thanks, Simon. This is probably one for Nathan. Can you confirm the company has over $200 million in tax assets? I assume that means credits. So no tax expenses for a few years. And
yeah,
that's right. What the capital allocation framework once debt is paid down. So
yeah, that's right. I mean, I think in terms of capital allocation framework, I think Simon's just addressed that quite well. In terms of tax credits, 200 million is probably about the right number. We'll firm that up for the year-end accounts, but yeah, I can confirm carry forward tax losses at around 200 million. Last time, sort of, I checked, and what that equates to for us is I expect we won't be a taxpayer for at least the next 3 to 4 years.
nice to know for shareholders with the opportunity for perhaps some dividends along the way as well. And following on from that question earlier, someone has asked, would you consider a share consolidation to avoid 5% bid-ask spreads? I don't know about that, but the optics of billions of shares on issue. I mean, market capitalization is as it is, but I know offshore investment companies do sometimes look at shares with 1 or 2 cents, and they don't pass their mandate.
Yeah, look, it's a good question. I think the jury's out on the value of those for shareholders. I mean, I think everyone you ask's got a different position on that, and have seen either ones go well or ones go badly. And I think that it's not top of my list. It's not something that I'm pursuing urgently. I mean, I think we're focused on the business. As I said earlier, there are other levers to trying to reduce the number of shares, and we'll obviously look at that as well. But look, it's something that's on the radar, but it's not one that I'm sort of pursuing in an urgent way.
And double the market cap, Simon, then quickly the share price obviously changes as well. So that would be the preferred pathway. You were discussing the market in bauxite just a minute ago, and which was reflected in the charts you were showing. What's your feeling and your sort of aspirations for the bauxite prices globally, and what sort of global impacts to the landscape do you see?
Yeah, look, it's a good question. Obviously, this is a function of two things. So obviously we've got demand, we've got strong demand, but we're also seeing the cost curve rise, particularly at the far end of the, on the right hand side of the cost curve. I don't have a cost curve chart in here, but if investors would like to go back to the Noosa presentation, that was the latest cost curves we had as of that time. And you can see a difference from the ones that we've been putting in presentations prior to that. So if you go back and have a look at the cost curve from the prior presentation, that the forward-looking cost curves have certainly risen by $5 to $10 on the right-hand side. And that's a function, that's obviously mainly the African or Atlantic suppliers, Jamaica and Brazil. And that's a function of not only their cost structure, certainly Guinea's cost structure is rising. So the fuel, the deposits are getting further away from the port. That means more transportation, labor costs are going up there like most places. And the freight, the freight cost from Guinea, whereas maybe a couple of years ago, you might have said, look, that might average $15. That's probably more like a $25, given fuel and given time charter rates. Now, of course, we see that flowing through our freight rates, but to a much, much, much lower sort of level, right? Because of our distance from the port, from the market. So what you're seeing is that cost curve, and that gives me also confidence that, of course, we're seeing inflationary pressures on our operation, but that's also flowing through to the market, and probably into an even more greater extent than we're experiencing. So last year was a difficult year inflation wise. We'll hope to see that coming off. We do need labor, a much freer labor, sort of market, if we can see that to get access to skills and people. But all in all, I'm seeing that right hand side. So longer term, even when the cycle starts to come in again, and of course, as soon as somebody mentions the word super cycle, the first thing that's going to happen is that we get a trough. So I'm certainly not going to say that, but I think we are seeing strong demand for the next, sort of short term, certainly. But even if demand drops or supply increases in that mix, we should see a higher level at which the sort of that bottom quartile price should stabilize at. And by that time, of course, I mean, our strategy here is to get to the scale where we get to the bottom of the cost curve. So our costs at 7 million tons should be we should either be the lowest cost producer or very, very close to it in the world. And from that point of view, that places us in a really great position for any future cycles that are coming through. So look, that's a bit of a short and long long-term view on pricing. There's also another element here, and you can see, which is less obvious in this chart versus that longer-term chart that I put in previous presentations, is that the gap between Guinea and Australia is now almost at an all-time high. So we've got over $20 of gap between those two bauxites. When you do, we have an independent group that does value in use analysis between the bauxites, and that gap should be much closer to $10, maybe even less than that, on a sustainable basis. So there is a, and we're seeing that, you know, in our customers where they're running the high temperature plants flat out, and the low temperature plants are being sort of, you know, sort of throttled back a bit. You know, there is a pressure to here for Australian prices to rise. Even if Guinea prices do fall, then there still should be a pressure to keep Australian high temperature prices rising to an extent.
Thanks, Simon. Comprehensive. Probably one here for Nathan, which follows on a little bit of that. One of our viewers says on his calculations, the second half of the year was profitable, but not sufficient to cover the losses for the first half. Do you expect to post a loss for 2023? And I guess in this ramp-up stage, that's would have been to expected. But you were talking about being at full rate and heading towards the bottom of the cost curve.
Yeah, that's right. That's a good question, and I mean, as expected, the second half of the year is always considerably stronger for us, naturally, given our seasonality, and especially this year with the ramp up from July onwards. I would expect that we would be, as expected, posting an accounting loss for the full period, but albeit with a healthy underlying EBITDA.
And probably dovetail into that question, discussing your contracts for the next 2 years, is the 7 million tonnes per annum fully covered? Perhaps talk about your customers as well, Simon.
Yeah, so we're pretty close to covered for 2024 now, coming into it. We had left some, I guess, gap on that through last year, just to in case we didn't feel as confident that on our production. But I think we've got about, I don't know, 6.8 million tonnes of contract offtake. There is some flexibility. Some of those, if you recall, in order to underpin the expansion and get lenders to assess risk with us in a different way, we did contract some tonnes in the middle of 22 when we announced the new DFS. We then contracted some tonnes out through 2023 and 24. So I'm calling those almost like the expansion contracts, if you like. So we've got some temporary expansion contracts. So about a third of our sales in 24 will be as a result of those expansion contracts. They drop off. There'll probably be a bit of a rollover into 25 for some of that, but they effectively drop off in 25. The two major contracts still roll through at that point. But from an offtake point of view, at the moment, I'm having to almost beat customers back. We're getting an enormous amount of demand. You can see there's a pricing issue, as I mentioned earlier. The value of Australian bauxite versus the Guinea bauxite is significantly higher. But also we're seeing very much a play in diversity of supply. So strategic procurement from our customers, which goes towards them looking to get a balance of Australian bauxite versus Guinea bauxite. So at the moment, as that transition is occurring in China, where you're seeing inland plants that are suffering from lack of supply from domestic bauxite, they are ramping down or closing, and you're seeing expansion and new capacity being built on the coast specifically to take imports, then you're seeing that strategic procurement coming into play, and certainly Australian bauxite is in that mix. And really at the moment it's about what letters of intent do I want to sign for 2025? Who are the best customers to do that with? So there's a strong competition, and we're trying to, I'm trying to create, I suppose, a sustainable portfolio with customers who are suited, who have the technology, the digestion technology or the organic treatment technology, which actually suits the Australian, the Weipa style, metro bauxite. So, we're trying to focus on those that have the technology, have the skills and expertise, and therefore will be a longer term sustainable customer base for us. So look, those negotiations are ongoing. As I said, we're pretty much covered for this year. We're probably about half covered for next year. But as we go through the year, I'm not anticipating a problem filling that gap for 2025 and beyond.
Simon, touching on ESG, is there an ESG factor in that favours Australian or metro bauxite versus Guinea bauxite, Chinese bauxite? Is that coming into play yet?
Look, that's a great question. I think if I stand back and look at an overall risk, there's certainly what you might call a risk component of that strategic procurement that comes into buying, and that factors location, Australian, I guess, regulations, sort of stability, I suppose, of the country, etc. Plus that ESG element. Look, I'd say that it's starting to come, and you can see, one of our customers, I put in some nice pictures, I think, in the NUSA presentation on, some of the aluminium products that are being produced by one of our customers. They go to Mercedes, they go to Tesla, they go to Apple, they go to these sorts of customers, So, of course, that's going to start, the whole blockchain, sort of traceability piece is creeping in, but it's not a significant thing at the moment, but it is increasing. And so we're preparing ourselves. We've set up an ESG committee at the board level in 2023. We're going to report back on that. That'll be a sort of separate area of reporting now going forward as part of our annual reports and sustainability reports. So we're going to have specific actions and metrics that we're going to be targeting and data and statistics to bring that in. And look, I think we're in a pretty good place given our very minimal footprint. Our biggest exposure is obviously diesel, and we're looking at trying to minimize that diesel consumption as we go forward through we've just put on new generators that are much more efficient as part of the expansion. We've got the new, all of our trucks are now Euro 6, sort of emissions qualified. All of these things are playing in. We're going to be moving to some diesel electric loaders as we go through the back half of this year as well. So all of these things are going to play into our consumption of fuel. We're looking at a solar bolt-on as well for the site and for camp to try to minimize the diesel usage here. So look, all of these things are in play, and look, but I wouldn't say it's a big issue now. But I think you can see the shoots of these things sort of starting to happen. Of course, there'll be Australian legislation, which also we're going to have to comply with as well as that sort of starts to take shape in the coming years.
Thank you. That's a good questions summary to finish this presentation on. I'd like to thank everybody for joining us here today. If you have further questions, please email them in to me, peter@nwrcommunications.com.au, and we'll make sure Simon and Nathan get those, and we'll follow up. Thank you, Simon. Thank you, Nathan, and we'll look forward to hearing the next update soon.